So once again, good evening, everyone. My name is Yukesh, and we'll start this session now. Today, we are doing a webinar on common mistakes to avoid during volatile markets. A lot of us trade, a lot of us invest. And before I continue to speak about this, please, if you can see my presentation, if you can hear me properly, use your chat options. Try to write yes or okay, so I would know that you're able to hear me properly, you're able to see everything properly. Unfortunately, chat is the only way we can interact at this moment during the webinars. So we'll try to make this much more interactive. If you have any questions, please continue to ask, and that is something which I have done in all my sessions. We keep the question answer open, and sometimes while we are doing sessions, it becomes easier for us to answer at that particular time. Sometimes we wait till the session ends, and I'll be able to, I'll try to answer your questions, right? Uh, Now, all of us, we have joined here for a common purpose to understand that what are the mistakes we as investors do. And when I say we, I include myself in this, because at the end of the day, trading or investment is it's not easy. Yes, it is simple. And what makes it simpler is to understand that there are different phases of economy, there are different phases of market sessions, and there are few things which are very common amongst all of us, right? And today we are going to discuss about those particular things. Now, to begin with, without wasting any time, again, we are going to do this a session which is very informative. Normally, what I do is I keep my notepads with me. If there is a point you think you can write over, we'll have the recording of this session out in YouTube in the next 2 days. So you can always revisit what we discussed. But then if you have any questions live, you can please go ahead and ask. And whatever information we'll be sharing today, it's more about what should be our investment strategy, what are the things we shouldn't do. But at the end of the day, I would always recommend to to speak with your risk consultants. Talk to us before you place any trades or before you go into any investments. This session is not about giving you recommendation of what to buy, what to sell. This is all about giving you a piece of information. And again, we are going to discuss one or two strategies to see that how we can invest in volatile markets. And these are very general strategies, but none of those information should point or indicate towards a fact that I'm recommending anything. I'm not recommending you anything. All I'm trying to do is give you an information. Yes, if you come to our office, speak to our risk managers, they will be able to guide you towards which are the good avenues to invest in. Without any further delays, let's try to understand. There are a lot of mistakes people do as investors, but then to sum up, there are 10 mistakes to avoid, which you should avoid during trading in volatile markets. And first of them starts with chasing the hot stocks. And guys, again, I have spoke to a lot of clients. I've spoke to a lot of investment experts over my period of study, and you'll be surprised at the end of the day, it all sums up to these very common mistakes. We're talking about hot stocks or chasing hot stocks. Now, it can be very tempting to buy a stock because it's been in the news a lot, right? Or everyone else seems to be buying it. But please do not assume that a stock is just a good investment because it's trending. Like, talk about biotech companies, talk about smaller market value mining stocks, right? A lot of such companies which suggest that you buy them now and these companies will pay you later in terms of capital appreciation, in terms of return. And these kind of companies, they get featured in media very heavily. But now that doesn't mean that all of them are very reliable investments, right? Because when markets are fluctuating, see, think about something like Bitcoin, for example, has been in the media for too long. Whether Bitcoin is going to be a success or not, that's a completely different discussion, right? The blockchain, Bitcoin, Web 3.0, zero proof of work. Yes, there are a lot of concepts. I'm sure there are a lot of believers, there are a lot of non-believers. But just buying Bitcoin or any other cryptocurrency because it is heavily featured in media, it does not represent that it's a reliable form of investment. Also, I'm just giving you an example, right? Now, whenever the market fluctuations, what do we mean by volatility? When I speak about volatility, so volatile markets means when uh, the ups and downs are like when it is increasing at a higher rate, when it is decreasing at a rate which is too fast. Today you sleep, you see markets down by 500 points. Tomorrow it is up by 300 points, again down by 700 points, up by 500 points. This is a volatile, it's a choppy market, right? And this kind of market does present opportunities for a lot of new market entrants. But then these kind of companies, right, or these kind of instruments, it's very rare for these kind of companies to really become successful, or these kind of instruments which are heavily featured in media that you buy them now and you see in future. During volatile times, this could be a big risk. Investors, I feel, might be better off starting their journey with an established market leader. So as of now, uh, basically what the bottom line is, do not buy a stock because of a headline, right? Check the sustainability of the company before you're investing in it, because uh, look at the numbers, look at the balance sheets, look at their competition, look at what product it is, what is the viability. Just because it is heavily featured in media or in news or any other channel doesn't make it a really, really good investment, right? Um, that is something which we have to look at this point of time. A lot of market experts, they believe that during the volatile times like this, uh, the riskiest of the products, they come down more and they come down first, and it could be irreversible for a couple of months or a couple of years, that impact, right? So always stick, as of now, stick with the quality names. Stick with the names which are basically large caps, giving you decent amount of dividend. There is an area called defensive stock strategy, where those companies which are defensive, when I say defensive, that means um, whose value does not get too much volatile during recessionary condition, right? Or when the market is going downside. These are some sectors like consumer utility, power, telecom. These companies are not fluctuating too much. At the same time, they give you a fixed amount of dividend also, right? So rather than chasing a hot stock like something in the news, let's take example Tesla, for example. Tesla has been in the news for too long, right? And every time Tesla makes a headline, investors would always feel, let's buy. Now, maybe in ordinary conditions, like probably an year ago or a year and a half ago, when inflation was not too much, when markets were volatile, but the conditions were completely different, the view was different. People would buy Tesla. But at the end of the day, see what's happening right now when inflation is hitting high. Most of the tech stocks have come down, right? So buy now, pay later strategy doesn't work during a lot of volatile times. You have to be very careful. And when I say it doesn't work, it doesn't mean that I'm 100% right, but the probability of you making money in a tech stock at these times becomes really less, because we see the downfall of the market as of now, it's very consistent. So sticking with good quality names, sticking with names which are quality names which have decent amount of dividends, can be a good idea. I got a straight away question here: how to manage the emotion control in Forex? A very good question. It's one of the, I have not put this emotional thing in my 10 mistakes, because emotions is given. And let me tell this to you right away. It's very difficult to keep emotions aside. I mean, you're not a robot. Even the best of the best disciplined traders, they have emotions. It just, there's an art of identifying your risk and reward. My father always says, even now, he's a graduate. He did not learn finance as such, but he says that I may not be a financial expert, but I understand this much: that if you're risking this bit, your reward should be this bit, and it cannot be vice versa. The problem with our emotions is, tell me how many of you, if you have traded or in any part of the investments, the moment you see something is in green, whether it is $20, $50, 100, $200, the moment you see this in green, you have this itching to book your profits right away. But when it comes to losses, you would continue to hold those losses, 200, 500,000, 2,000, 5,000, until your position incurs a heavy loss and you are forced to get out of the trade and close it. That is the example of how our emotions take control of the trading. We are ready to lose this much, but we make a profit of this much. And that's why we have to understand that there is a proper risk and reward ratio. I have my live platform on the other tab, and I'll share that how you can trade, how you can use a few market neutral strategies during these times. So stick with me. And a lot of this discussion will extend once you visit our office. Sit one to one with us, and we do these training sessions free of cost. Whether you have opened an account or funded or not, it doesn't matter. Come to us, talk to us, and we'll sit one on one and speak with us what you're looking for, and we'll tell you, what are the investment opportunities you can look into. Now, after understanding that we don't have to chase the hot stocks basically, or something which is heavily featured or talked about in media, just stick with your quality names at the moment, something which gives you a decent amount of dividend and has less adventure at this moment. Move on to something else. Second mistake, which a lot of people do, relying too much on the performance of a single stock. Now, let's say that right now, for example, the market is experiencing good turbulence, right? And you have heard this rumor that a big company is going to deliver really big gains and really good results. What do? You sell some of your shares so you can buy up that big company. And now the majority of your portfolio is invested into that a big stock. So you are feeling that I'm well positioned to make a really big profit in the coming week. But what happens in the coming week? The market shifts. That big company does not perform the way you thought it would, right? And stock actually ends up delivering a loss. Now, because you invested such a large proportion of your funds in that one company, you increase your risk, and now you are tied up with a large portion of that money, right? So, this is something what in finance we call them as concentration risk. Concentration risk means you rely on one asset class, you concentrate all your funds, all your money into it, but you have to diversify. We'll see another mistake which people do. They don't diversify, which is slightly different from what I'm talking about right now. Of course, that you diversify, but even when you are diversified, don't rely on a sector too much, right? Just because of, even if you have heard the news, even if you are very sure or confident, putting all your funds into, or majority of your funds into, one industry or one sector can be a dangerous thing, and it's one of the common mistakes which a lot of investors do during these turbulence times, because what you're looking for is quick profits. Now that desire could come from the fact that you might have lost a lot of money and you're trying to take revenge from the market. But then please, as I said, do not rely too much on the performance of a single stock. Third, mistake number 3, panic selling stocks for cash. Now, would like to spend some time on this because this is something which a lot of us go through. All of us go through. In fact, I go through a lot of times this, because when we are in a volatile market, what is my basic human instinct? My basic human instinct is that I want to invest in new stocks or a mutual funds as soon as, if there is a big loss, I just want to get out of it, and I want to invest into something which is different, which is new. In a lot of cases, investors who are starting early, or they have not experienced the market crashes, what they do is they panic, they sell quickly, and sometimes they buy quickly. Like if there is a knee-jerk reaction, knee-jerk means, let's say a stock just fell too much and they feel that, okay, it has come down, let's buy it right now. Or similarly, if a stock has fallen down too much and you have trades in it, you sell it right away because you're in panic. What you are risking is you could miss out on a great investment opportunity, right? Maybe if a stock has fallen down, it could be a right time to buy more and average it, right? And averaging it itself, right? If averaging is done right, then it could not be a mistake. But if averaging is done in very small proportion, if let's say Apple is 150, it comes to for 149, you buy. If it comes to 147, you buy. If it comes to 145, you buy. That's not what averaging is. Averaging means if let's say Apple from 150 came down to 140, you entered. From 140, it came down to 120 or 110, you entered. Basically, a 10% or a 15% loss could be a good averaging price, right? Depending on how volatile the stock is. And on the other side, if you see a stock falling down and you quickly enter, you panic buy because you're feeling that, you might miss this train, you may wind up with something that is a very temporary, that was a very temporary increase or decrease, right? And it does not add any value to your portfolio. So many investors, they make this typical investing mistake, and that's why you should avoid falling into such traps. Invest in only those stocks which are capable of boosting your portfolio in the future. But I will still stick to what I said in the first part. I'm talking about blue chip companies, large cap companies, especially in the times like this. Do not take experiments with your portfolio, right? Because when I say this again, that doesn't mean that you just set and forget about it, right? It's not like if for example, there is a stock which is bleeding bad, that doesn't mean that you just keep it and forget about it. No, that is going to eat up your entire portfolio. But you have to see that whether there is a possibility of that stock moving higher or not. Talk to your risk consultants, look at their financials, right? Rather than being guided by market noise or market rumors, you have to look into the much in-depth analysis of the company. And in a lot of cases, you see volatility, it finally passes, and investors who continue to keep their money invested, they're usually better off, right? So that happens a lot of times. A lot of investors, they find some comfort in tracking their portfolio against a benchmark. Now, this is also another thing which I wanted to point out. If you are invested in funds, like for example, instead of investing into individual shares, if you were invested into an index, while your one share could have fallen down more and affects your investments, an index like S&P 500 has exposure to 500 companies, or a mutual fund or an exchange traded fund which has exposure to different geographies in different stocks could be a better idea in the volatile markets, rather than focusing on one specific stock or selling all your investments right away, right? So that is something which we have to look into. Now, this is really important, over leveraging the portfolio. And I'll show you the example of over leveraging right away. I have my platform open. Leveraging means using borrowed funds to magnify your gains. But what we don't understand is that your losses can also get magnified when you are over leveraging it. Let me give an example of leveraging. When think about real estate, if there's a real estate which is $1 million, right? If you're buying a house which is $1 million, even if you have cash of $1 million, you will still avoid. You feel that, okay, let me pay a down payment of 200,000, and rest I can mortgage it from the bank and keep paying interest over it over a period of 10, 15, or 20 years. This is called leveraging your investment, where you are using bank's money to actually buy a house and invest. What happens through leveraging is it increases the efficiency of your capital, because if you put entire $1 million cash in that property, then you could not be able to invest anywhere else. And we all know that real estate is a very illiquid asset. You buy today, and if you want to sell tomorrow, you can't do that, right? So what you can do is you put 20% of your down payment into that house, and the remaining cash which you have, you can put into stocks, you can put into funds, you can buy bonds, you can invest anywhere else. That's why people take leverage. This kind of leverage is available on online trading platforms also. And let me share my live platform with you right here. And I'll explain it to you how this works, because that's the most important thing. A lot of investors, they don't understand. They play with leverage and they feel that, this is something which is really cool and I can make a lot of money. Now, let me just share the screen with you. Okay, let me know if everybody can see this. Just going to magnify it right now. And just took two demo trades, short selling gold and oil. Really small profit, but yeah, it's good. Now the problem with leverage is everybody takes leverage thinking that I'm going to make a lot of money. And leveraging your portfolio can lead to that. But what many people don't understand is you can actually lose a lot of money also. And let me tell you how. What I'm going to do this, let me just close my existing trades. And let me show you this. So right now you can see that there are no other trades open. This is account $100,000. Of course, it's a demo account. It's a practice account. That reminds me, all of you can have one practice account. Just talk to your relationship managers by the end of this session, and they will not only just give you the practice account. If you want to learn that how to use this and how to buy and sell, you are most welcome for a one-on-one training session. I'll be there. I'll be taking care of that. Just to explain it to you how a practice account works and how you buy and sell, right? Now, over here, you see there's account value of 100,000, 101,000. Please tell me if you can see this portfolio. Use your chat options. Send me a yes or okay if you can see my portfolio. Sorry, if you can see my platform, right? If you can see everything properly, you can see the numbers. Is everything okay? I can see few of you are okay. A lot of you are through web, so I don't think there should be a problem. Some of you are through mobile. Okay, if you're on your mobile phone, I hope you can see this. Please use your chat options. Tell me if you can see my screen properly. This is the most significant part. Leveraging is something which you have to understand the risk behind this, because this is why a lot of people they lose money in investments and trading, because they over leverage. Okay, perfect, perfect. A lot of you. Thank you so much for replying. It's a very, very interacting crowd. I love this. Now, let me show you. Now, I'm going to give you, I'm going to take a trade which is not very leveraged, right? And then I'm going to show you a trade which is maximum leveraged, okay? Okay, tell me, use your chat options. What would you like me to buy or sell? Gold, oil, any global stock, anything, tell me. Let me see if I have here Apple shares or okay, it's active. Great. It's not clear. Visualize. Kindly zoom a little bit. Okay, okay. Let me just zoom my screen over here. Thank you so much for pointing this out. Let me zoom it a bit. Here, here. Okay. Is this okay? I just made it 150% zoom. I might have to move it through the screen, but I think it should be okay. Okay. Gold, oil. Okay. I have a lot of votes for oil and gold, so I'm understanding not much of a equity fans over here. Okay, let's take gold and oil then. Something which, if you're tracking this, nothing better. Let's say gold. So I just search in my product library, gold right here. And all I have to do is click on the buying price. Now I have $100,000. As you can see on your screen on the top right corner, this account is $101,000. Now, how leverage works is that if I want to buy gold worth $50,000, I put an amount of 50,000, right? And I click here on buy. But what I have to understand is that even if I have $100,000 in my account, the online platforms will not use your full money to buy this $50,000 worth of gold. They will not take $50,000 from your account. Rather, just like the real estate example I gave you, you deposit a 0.5% of the total value, which is so $50,000, 0.5% is $2,500. So that is something called a margin payment. So you give a margin of 0.5%, but you can still have gold worth $50,000. Just like you can buy $1 million house, but you still just pay a down payment and rest the bank finances you. Similarly, over here, you can buy $50,000 worth gold, but you just have to pay 0.5% margin and rest the broker finances you, right? So 0.5% of 50,000 is 2,500. Again, if you have $100,000, it doesn't matter how much money you have. All you need is $2,500 to trade $50,000 worth of gold. This is called leveraging your portfolio or margin trading. When you use borrowed funds to buy or take a trade, right? Whether it is stock, index, gold, or oil, it's going to work in the similar way. Now, let's take a trade. You have $100,000. You are buying $50,000 worth gold, for which you are blocking just $2,500. I click on buy, order placed. You bought gold right away. And how can I see this? I click on my positions, and now I can see right here I have a floating loss of $11. It will continue to go up and down depending on. So I have bought over here. Okay. Right. $50,000 worth gold, 30 ounces, and on which I have a loss of $9 and continues. Now, tell me, if I have $100,000 in my account and I have bought gold worth $50,000, blocked $2,500 as a margin, tell me how much maximum I can lose in this trade. Go for it, guys. Use your chat options. Use your chat options. That is the only way this concept will get clear to you. If I have bought gold worth $50,000, I have $100,000 in my account. I have blocked $2,500 as a margin money to buy this, which means I still have around 97,500 in my account. But my gold value is $50,000. What is the maximum amount I can lose? Okay, perfect. The chat starts coming now. Guys, a lot of you, anyone, please start using your chat options. Tell me. $50,000 worth gold. Okay. 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 Perfect. Perfect. Somebody just said indefinite. There is a value to it. There is a value to it. It's not indefinite, but I understand why you're saying indefinite. So basically, we never know how much we can lose. So that, but let's take a worst case scenario. Somebody said the entire margin. So margin is something which is blocked against a trade, right? Now, if your loss exceeds $2,500, you mostly have to add more money, but here you already have $100,000, right? So your trade will not be closed out. But what you can lose in this entire trade is, a lot of you have answered it absolutely correct, $50,000. If I have purchased gold worth $50,000, assuming that gold value will go to zero, I know it's a very absurd assumption to do it, but let's assume the worst, right? Gold value goes to zero. In your $100,000 account, you lose $50,000, right? Because you bought something worth 50,000, it went zero, so now you lose 50,000. That's your maximum loss. Now I'm going to take this trade further and I'm going to over leverage it, right? Over leverage means I'm going to max out. And before I do this, please do not try this in your live accounts or real accounts. This is a practice account and I'm showing you an example of an over leverage trade. It's entirely risky. Okay. So do not do this in your live accounts. Now, what I'm going to do is I'm going to buy, because to buy $50,000 worth, I am blocking $2,500. So if I have to buy, let's say here, $2 million worth gold. $2 million worth gold. 0.5% will be how much? $100,000. I have already a trade where I have used $2,500, so I just have 98,000 remaining. So let me reduce it to 1.9 million, for which I need a margin of $94,000, 0.5%. Now the point is, I have 98 remaining in my account, so I can use 94,000 and buy gold worth 1.9 million. 1.9 million. I click here on buy. Turns out I can buy gold worth 1.9 million. See, I have two positions now. I bought one right here. Let me show you. Look at the total amount. One, I bought $50,000 and now I have bought worth $1.9 million. So now I have total gold position worth 1.95, which almost $2 million. Look at the loss. The loss, which was $10, $11, all of a sudden it's 500, 550. And I bet the more we speak and more prices go down, you will see these losses exceeding 500, 1,000, 1,500, because right now you have around 1,100, 1,200 ounces of gold. Tell me, if gold goes down by $10, a quick profit and loss calculation. If gold goes down by $10 and I have 1,200 ounces, what is my total loss? Use your chat options, guys. If gold falls down by $10 and I have 1,200 units or 1,200 ounces of gold, what is my total loss? Make sure that you write this out so it will be easier for you to do any future profit and loss calculation. Just to give you a hint, whatever is the total price by which it has come down, multiplied by the number of shares, exactly, number of ounces, exactly. So $10, as all of you have answered it right, $10 multiplied by 1,200 ounces, $12,000. $12,000. Just $10 drop. Gold moves on an average. Let me show you today how much gold has moved. Look, so over here, if you see there is a small L and a small H, lowest gold has, or let me show you in a watch list, which will be a better idea. Let me show you here, gold. Look at the lowest and highest over here. Lowest is 1661, highest is 1678. It has already moved by at least $17, $18. And on daily basis, gold moves easily around $15, $20, $25, which means $10 drop is nothing. It can always happen, and you can lose $12,000. Why? Because you have taken a $2 million position. This is the magnitude. And tell me, if gold goes up by the same price in a day, you can make $12,000. If it goes by $20 up, you can make $25,000. All you have to do is put 100,000, take a $2 million position, and if price goes up by $10, you make amount, right? Now, this is the common notion. A lot of investors feel it that way. That okay, let's take a risk. Let's do over leverage. If it is definitely going to work in my favor, I'm going to make money, recover quick. But that's not the right thing to do. Please avoid this. Never use your entire leverage. In fact, I would say that if you're a conservative investor and if you have put $100,000, whatever you buy it worth or within 100,000. Most of the conservative investors, so somebody just asked a question that what's the right leverage to take? A very good question. If you are a conservative investor, you are putting $100,000, at best, take a trade one time more than that. So if you have put $100,000, you want to enjoy leverage, probably $150,000 or $200,000 worth. So one time more. If you have put $10,000, probably do trades worth 20,000. But if you increase your leverage more than that, in these volatile times, you are exposing yourself too much, right? There are a lot of risk management tools, putting a stop loss and again, everything. But as I said, diversify, manage your risk. And if you're thinking of taking a higher leverage, please make sure that you understand the risk behind it. A lot of clients, they would just trade on margins without even knowing how does it work. And eventually they lose. Think about this. This is a $2 million position, right? In a previous example, I said that if you buy gold worth $50,000, now tell me this. In the previous example, I asked you that if you buy gold worth $50,000, how much maximum you can lose? A lot of you said 50,000, given if gold goes to zero. But now you have gold worth $2 million. Tell me how much you can lose because you just have $100,000 in your trading account. So give me this answer, guys. If you have $2 million worth gold, and if gold prices drop, what's the maximum amount you can lose? Because you have only 100,000 in your account, but your trade worth is $2 million. So what's the total amount you can lose? Maximum. All right, here the answers begin. Go ahead. Come on, guys. This is the time you will understand this. That's why I'm asking you a question. I know it's a very stupid question, but this is how we interact and this is how we'll know. Okay. So some of you answered, first of all, you can lose your entire money. So you can definitely lose your entire money. So $100,000 can definitely go down, right? A lot of you said more than 100,000, which makes sense, right? Because you have a position worth 2 million. So tomorrow, if gold goes down, let's say not to zero, but if the prices fall by 50% also, you still lose $1 million, but you have 100,000, right? A lot of you have answered that the moment loss reaches close, somebody said 1.9 million right away. Hang on, right? If gold goes to zero, you can lose $1.9 million. But then how the broker is providing you this much leverage, right? There are a lot of clients enjoying this leverage. And if everybody starts losing, you won't be able to pay 1.9 million, right? or you choose not to pay 1.9 million, that is where the broker understands this. And the moment your account is closer to your capital, so if you have put $100,000 and your margin blocked is $100,000, the moment your account comes down, a lot of you have answered right. The moment account value drops by 50% of the total margin, the broker closes your trade automatically. So if you lose $50,000 in this trade, automatically your $1.9 million position will be closed. The broker basically does not allow you to lose more than what you have deposited. Now, that is something which is a protection given to retail clients, right? Retail clients are the one who are not professional clients, and professional clients, they qualify for a different criteria. But a lot of retail clients are given a negative balance protection and a liquidation point where if account value drops to the 50% of your margin. So if you have bought $2 million worth gold and you had $100,000 with you and margin used is $100,000 full. So the moment your loss reaches 50,000, your entire trade will be closed. So you will not end up losing more than that. This is another problem. Why it's a problem? Because investors know that. So they feel that, okay, let me take a $2 million position. My max loss is what, 50,000. I will be liquidated out. But if it goes up, I will end up making a lot of money. This is the mentality which we should erase it completely. Look at the loss right now on this position. It's around 700. It went to $1,000 also, right? So we have to be very careful, guys. Leverage it's a double-edged sword. If you abuse it, you're definitely going to lose your entire capital, right? So be very careful about it. Never take over leverage, and that is something which we should always understand, that over leveraging the portfolio in volatile markets, that's the worst thing you can have, because in volatile markets fluctuations are too high, right? So don't over leverage your portfolio. Another common mistake what people do is they try to time the market. Now, let's say, let me tell you a fact. An investor, let's say any investor who was out of the market, and this is a very known fact, by the way, right? You can find it anywhere. You can verify this. Any investor who was out of the market during the top 10 trading days of S&P 500, and I'm talking about a period between 1993 to 2013. 1993 to 2013. Okay, and I'm talking about good 20 years, right? In those 20 years, if any investor was out of the market when S&P 500 traded the most, like the highest returns or the highest volatile, top 10 trading days, high volumes, that particular investor would have achieved an annual return of around 5.5%. But overall, the index performed 9% over the same 20-year period. So what I'm trying to tell you is, if you would have been invested throughout the 20 years, right, you would still gain 9.5%. But if you miss out on those top 10 trading days, your returns cut into half for those 20 years. Many people who sell during market downturns, they definitely, on the paper, they have monetized their losses, right? But they also miss out the buying opportunities. Some investments over a longer period of time, when market recovers, can again give you improved performance. So it is important to remain or to be invested in the market during those top trading days, right? That is the time when market usually follow the corrections. Market timing, I'm not saying that it is completely possible. It's really very hard. Everybody wants to buy. Think about this. That bottom, when pandemic happened, lockdown happened, market went down and then recovered. That bottom, I'll show you the chart over there, and we'll be able to see. How many of you were able to catch that bottom? Right? Market timing, it's possible. It's very, very hard. But a lot of investors who are not really experienced, are like a lot of us. And again, when they try to do this, it becomes a little difficult. So do not try to time the market. This is something which is a problem. We try to get out of the market, wait for the bottom. When it will come, then I'll enter. No, within the period, there are a lot of times when index stocks, they trade at their best, their higher volumes, right? Investing, not investing is one thing. Booking your profits, booking your losses is one thing. But getting out of investments at all. So I'll talk to a lot of people. Sometimes they say, no, no, right now it's not the time to invest. Please let me remove this myth right away. Every time is a good time to invest. Oh, and there is no, or let me put it this way, there is no bad time that you should not invest. You should invest. You just have to pick your stocks carefully. If right now inflation is at its peak, don't invest in technology. Invest in consumer defensive, invest in consumer staples, gas, electricity, power, these kind of companies, or Coca-Cola, for example, giving you a dividend, right? Mature companies, blue chips, financial stocks, for example. But every single time you have to remain invested, because getting out of the market is not a solution. You could be missing those top trading days, which can reduce your returns by half over a longer period also. So that is something which you have to understand. Not diversifying, lack of diversification, whichever way you want to call it. Diversification, guys, it's a really, really important thing. A lot of investors, they always believe that if you take, as I was saying, that if you take a large investment exposure in one or two asset classes, or in a specific stock or in a specific sector, you are going to maximize your returns. It's a big mistake, because the stock markets, if you see overall time, you will realize that stock market kind of, you know, give promising returns. When you compare it with any other asset class, you compare it with bonds, or you compare it with real estate also, at times stock markets, they give you better returns, and it's more liquid. But then the risk also comes in, right? You cannot put all your eggs in just stocks. You have to diversify your portfolio. So some of your money should be in stocks, some of your money should be in bonds, some of your money should be in real estate, some of your money should be in gold, some of your money should be in agriculture based commodities. So diversification is, guys, really, really important. Sometimes I talk to the investors, I ask them, are you diversified? He says, yeah, we are diversified. uh, we have Apple, we have Google, we have Microsoft, we have Tesla. No, that's not diversification. You're still into the same sector, you're still into the same industry. Something like today, tech goes down. What are you going to do? So, overall industry, overall investment options. Somebody just asked that are newer IPOs in UAE attractive? See, without a doubt, uh, UAE is now opening up. So, DY IPOs, Salik IPOs, these are the ways of UAE telling the world that now we are opening up to, bring IPOs to. So definitely, I mean, a part, as I said, just investing into one economy. If you only invest into UAE IPOs, even that could be a yield to a losses, right? Because you're just focused on one. Is it a good opportunity? Yes. It's time to diversify. A lot of people at this point are diversifying. So I would never ask you to not invest into emerging markets like India, right? Everybody wants to invest. Look at if you compare today INR and USD INR and dollar versus other emerging market currencies. Yes, INR has depreciated. A lot of other currencies, emerging market currencies, have against dollar. But if you see the rate at which INR has depreciated, and when you compare it to the other countries or economies, you will see that the rate is still slow, right? It's the reason is there is still a lot of foreign direct investments in the companies. If you compare India and China at the moment, uh, China has still not shown that kind of confidence. Investors don't feel very confident right now in investing in Chinese stocks, right? Ask yourself this question. When was the last you felt confident about investing in Chinese stocks? There has been a big fall, first of all, in Chinese tech companies due to changes in tech regulation that happened last year, followed by high inflation, right? Followed by pandemic supply constraints. We have seen stocks like Alibaba falling from $300 to all the way $70, $80. So as of now, China is not giving that kind of confidence that doors are open for foreign investors. But when we look at countries like India, they're still very open for foreign investment. So that's why a lot of FDI investments, we talk about Adani stocks or Reliance or anyone, there is a lot of FDIs which are getting involved, right? So emerging markets will always be a good idea, but your exposure has to be, you have to diversify. So you put in UAE markets, you put in Indian markets, you put in US markets, UK markets. European stocks at this point of time is a little, a lot of investors are away from them given what's coming next. High inflation, European Central Bank still expecting to increase the rates. Then there is a whole Russia, Ukraine, there's the energy crisis issue. So, but other than that, there are a lot of other economies you should diversify into, and not just stocks wise. You should look into bond investments also. Try to find out those bonds which are linked with inflation. There are a lot of bonds whose coupons go up or down depending on the inflation rate, right? There are a lot of corporate bonds. There are a lot of companies which are issuing bonds with a decent amount of yield, right? So you diversify into high yielding bonds, low yielding bonds, uh, dividend yielding stocks, growth stocks. Then you diversify into real estates, different markets. But don't keep all your eggs in one basket. I'm sure you must have heard this thing millions of times. But when you come and speak with us one on one, we'll explain it to you that how you can diversify your portfolio into different economies, into different sectors as well, right? So diversification is something which we definitely need during a volatile market. It may be a very useful investment strategy, right? If you have any cash in idle, you can use systematic investment plans, SIPs, what we call it, which will be again one of the other option where we'll see that how you should not discontinue your SIPs, because a lot of people they feel this way that systematic investment plans, already when prices are coming down, should we buy more? So you will realize that actually discontinuing your SIPs could also be a bigger problem. So we'll discuss this thing as well. Another thing, reacting to the media. Now there are multiple sources of information. Facebook. There is another separate university called WhatsApp University. A lot of us are students to that, right? We keep forwarding messages. We don't even know the source, whether it's right or wrong. But reacting to the media and taking investment decisions on the basis of what media is saying, that's the biggest problem right now. Because all of us love stories, right? And media is great at throwing stories. Like if you're reading forum, for example, something like Reddit or any other financial journal, right? Now, if you're reading that, first of all, it's a really good. You should always read financial blogs. I think knowledge is very important. But when you look at 24 hours news channels, they try to sensationalize this thing, or they will exaggerate market changes. Basically, attempt to make you money by showing tradable information, right? They act as your guiding light, but you have to understand that you should never replace that media noise with your actual research and analysis, because by the time this information is discussed on the news, it has already become public. So that has already been factored into the market pricing, right? So this is something which you have to understand, that media has its own role to play. Do not replace that media shout by don't overshadow your research and analysis. That is the most important thing. Media will always tell you the information which is already there in the market, and probably it has already been priced in, already been factored in, right? So always be careful when you are looking at the media. This is one of the most common problems over the period of last 15 years. I have seen with clients that this has been a bigger problem. Trading too much, too often. Now, trading too much is it's, and let me tell you this thing, trading is an addiction also. Please be away from this. The sooner you realize this, see, patience is a virtue when it comes to investing, especially. It takes time for investments to grow, right? You cannot have quick money unless you over leverage it, gamble around it. That's one thing, but that's not advised, right? It takes time for investments to before you reap this benefit, right? You allocate your assets, you create a strategy, and it takes time. You have to continue, you modify your portfolio's composition. Sometimes there are some bad investments we do, get rid of it, add it with something else, rebalance your portfolio. Now, adding or trading continuously will only generate commissions for your brokers. Understand this. And that is one part. Generating commissions, or tomorrow you say I'm working on zero commissions, it's a different thing. But trading too much exposes your portfolio also to a very high risk. Sometimes there are days I would always tell clients, today, for example, what's the time? Okay, 7:52. I think today itself, not I think, I'm sure, there's a Fed rate decision. Central Bank of US is going to take decision on whether to increase the interest rates by how much, right? And a lot of investors would trade at 9:45 p.m., especially because the rate decision comes out and there will be volatility, so they feel they can buy, sell, get out of it. Real point is, don't trade at that particular time when rate decisions comes out. There is a lot of volatility, right? Any trade you place, it's not a rational trade because you feel okay, buy, there will be buying and selling. The real cream starts at 10:30 p.m. when the press conference begins. Even in the press conference, there are questions asked with the central bank governor. What is your expectation? What is your expectation for the inflation? Do you think that increase of this rate is going to make sense? Do you think inflation will be under control? And all those answers, they shape up the market for the next day. So when the storm is done and dusted, only then enter into the market. Just looking at the volatility, okay, rate decision now, let's trade right away. That is, if you put a stop loss, it's going to get hit. If you put a take profit, it's going to get hit. You will never be able to maximize anything. Okay, so always get away from. Don't trade too much. Not don't. There is no book which says that you have to trade every day. Okay, just do your research right. Keep your risk and rewards proper and trade when it is needed. There are 22 trading days if you remove Saturday, Sundays out. Out of those 20 trading days, there could be 5 or 6 days where maximum news comes out, or 10 days where maximum news comes out. Target those 8, 10 days. And this is, I'm talking about the traders, right? Obviously, the long term investors, they have a different thing. So they are not the ones who are trading too much. This is for those investors who are traders, they trade too much. So trading too much, guys, not only it gives away a lot of transaction cost to your brokers, but also at the same time, you're risking your portfolio way ahead. Next is taking too much or too little, or basically the wrong risk. Too much risk is over leveraging. Too little also at times where, so risk, there is one thing to be risk, like what do you call it? Yeah. There is something called risk averse. There is something called loss averse, right? You be risk averse, that's not a problem. But you cannot be loss averse. Loss averse means you can avoid taking a higher risk. You can be scared from the risk. I still understand. Cannot be scared from the losses. Losses will happen. That's the part and parcel. But because of that, not taking a high risk is a problem. So not taking a risk because of your appetite and everything is fine. But just because you're scared that I will lose right away, it can be an opportunity which you just lost. So the right amount of risk is important. Not too high, not too low. And again, a lot of risk managers, they help you out with. They try to market neutralize it. Because investing at some level, it involves risk for a potential reward. See, understand, if you spend time in trading or investing in your research, it should be worth something to you. Now, taking too much risk, again, it can lead to a very large variation in investment, right? You will be out of your comfort zone also. But when you take too little risk, that can result in returns which are too low to even achieve your financial goal. Tell me, how many of you have a financial goal or a financial objective to achieve? And again, I'm not here to talk about financial freedom, financial independence, and all of that. I'm just saying, how many of you have an objective that, okay, by the end of 2 years, my investment should give me at least this much, right? If you have that investment objective, if you have that investment goal, then there is a certain level of risk which you have to take, right? Otherwise, these are just numbers in the air. So your portfolio risk doesn't necessarily change, or nor there's a reason to reduce it because of increased market volatility. It's just, please make sure that you know this, that your financial and emotional ability to take risk, and that you recognize that you are comfortable with that investment. That's the most important thing. Is this the money you are saving for your child's education? Is this the money which you definitely need in another next 3 months? Do you have an emergency fund with you? What pandemic taught us? 3 months of lockdown. not going anywhere, no economic activity, right? A lot of our friends, family members, a lot of people, not only they lost their lives, a lot of people also they lost their livings. Think about a lot of people who lost their jobs. I'm not sure whether you are one of them or not, but the point is we have to understand one thing which pandemic taught us: we need to have an emergency fund. An emergency fund should be calculate your monthly expenses today. And imagine that if you don't have a job for 1 year, every month, will you be able to use that fund to pay off your expenses? If my monthly expenditure is 20,000 dirhams, I would see, okay, for the next 1 year, if I don't work at all, 360,000 dirhams. I will save 400,000 dirhams, keep aside. That's my emergency fund, right? It's important to have an emergency fund because if you don't have that, then any sudden drop, or any sudden event like a lockdown can impact you. So this is a very popular opinion, guys. Now you need to have an emergency fund. And when you are taking risks also in your portfolio, it doesn't matter. Okay, volatility will always be there in the market. High volatile, low volatile is one thing. But whatever risk you are taking, you should be mentally, psychologically be okay with it. And when I say okay with it, doesn't mean that let's take the trade, we'll see what happens. If you're going to lose this money and if you're going to sulk over it for another 1 month or 1 year, then you are not an aggressive investor, right? Then that's not the risk which you are willing to take. But if there is an amount that you know, okay, I'm ready to take this, this is not going to affect my emotional ability, this is not going to affect my household, this is not going to affect my long-term targets. This is the money I can risk. Now that's important. Now that risk can be high, can be low, but as long as your emotional stability doesn't get affected, trust me, guys, I have seen investors who got addicted to trading and they had to go to rehab to get rid of it. People losing their eyesights over looking at the computer screen 24 hours. That's not what we want. That's not, we also provide online platforms, but that's not what we are teaching clients out there. We're telling them risk management, we're talking about market neutral strategies. Now, as long as before the session ends, I'm going to share it with you how a strategic investment looks like. Before this is the last mistake number 10, which a lot of investors do: discontinuing the SIPs should never be discontinued unless if there is a stock which has shown really bad performance going to get delisted. It's one thing, but if there is a commodity or there's a good fund or there's a good stock, it's just down due to market movement. Do not discontinue your SIPs. See, SIPs are important. Instead of trying to time the market, try to time your investments and do these investments regularly. SIPs is one of those areas. And you can have SIPs in stocks, gold, anyway. You don't have to have a plan of SIP. You can, let's say you put $100,000, but don't buy everything with 100,000 right away. Use 5,000, 5,000, 5,000 every month. Keep putting in a certain amount and do that. I've seen a lot of times investors, they stop contributing towards these long-term SIPs whenever they witness a slump in an index. Now, when we talk about something which is the macroeconomic, geopolitical tensions between Russia, Ukraine, right? This has already resulted in such a strong price drop in stocks. We have seen this. But these kind of events, we have to understand these kind of events are short-lived, right? They will always lead to market volatility. And of course, these are unpredictable times, but then these are the times which are ideal for investing also. And technically, investors, they should buy more of good mutual funds. Please don't take me wrong. Don't think that I'm saying two things at once, right? Do not take me wrong in this. As I said, every time is good time to invest, but you have to pick your investments, right? If you see that there are mutual funds which are worthy, if there are ETFs which are worthy of buying it, prices have slashed, okay, start buying, start contributing in a form of SIPs. Investors, us, and when I say investors, I include myself in it, we have to focus on asset allocation. We have to build long-term positions, right? We have to use this market volatility in our favor. That's why we are doing this session. You should always continue the SIPs, right? At the end of the day, you average it. There is a dollar cost averaging. It always works out well. This is the best times in market volatility when averaging works out for you, right? If Apple is at 150, you put $5,000. It goes to 120, you put $5,000. Goes to 100, put $5,000. So you get an average price. The moment starts moving higher, there is a certain amount of profit. So of course, there's a short-term event will always, like a conflict, whatever happens, Russia, Ukraine, anything, it's a short-term event. And every stock investor is generally someone who has invested for the long run, right? There are a lot of investors who do long-term investments. So today, when you're looking at your losses, maybe longer term, when the gains happen, these losses will be offset. Always remember this, guys. Volatility now is the new normal. Okay, high volatile markets, they're unpleasant, I understand, but then these are temporary situations. You can always overcome your losses if you hold the worthy investments and not panic, right? So just to, before we move on to the last strategy bit, uh, somebody just said that the question is to sustain such impacts, right? So how you sustain such impacts, and again, an important thing to highlight this, that you have to, whenever the market drops, if you have not over leveraged your portfolio, I'm also a regular investor, and I'm telling you this by experience, that, and I'm sure a lot of you have enormous amount of experience in this area. If you have not over leveraged your portfolio, and if you have invested in quality worthy companies, a 10-15% drop will only look like an opportunity to buy more. But if you have invested in low market value companies, which you heard from somewhere, normally, you know how investors tip I. I've received a tip. And so I heard this somewhere that only people who make money in tips are the waiters. Nobody else. Investors don't make money on tips, right? It's all about understanding the research bit. So if you have worthy stocks in your portfolio, no matter how drastic the market goes, if these are cash-rich companies and diversified into defensive sectors, you will always get the opportunity to buy more, and that impact, you will always be braced for the impact if you're diversified, right? So we have to understand this thing. Before, guys, we move on to the strategy part of it, if you like this session, please go on Century Financial Google reviews, rate our sessions, good or bad. We keep doing this every Wednesday. We even conduct one-on-one trading sessions, and these are free of cost. We teach clients a lot of things. We learn a lot of things from them as well. So please, if you like these sessions, please review us, and we'll continue to do these sessions. Now, just to conclude, before we move on to the strategy, one or two strategies I would just like to show you. Please, guys, understand, we make mistakes. It is an inevitable part of investing process. Today we'll make mistakes, we learn tomorrow, right? The important part is knowing what these mistakes are, right? When you commit them, how you should avoid them, then only you can succeed as an investor. Investing is a roller coaster. It will always be a roller coaster, right? There will always be panic, different scenarios, but you have to avoid, to basically avoid committing to these mistakes, right? You talk to your financial risk managers, talk to the consultants, enhance your knowledge more, understand the sessions, learn more, read more, but be away from the media. Be wise, be prudent with your investments, right? So look at your focus on your long-term goals. Continue to invest in your asset class like equities, bonds, right? Look at the market condition and see it that way. Now, coming back, let me just switch to strategy. What I was talking about, and that is something I want to look at. Okay, here is this is the tab right here. Let me open one strategy, and this is one example of a market neutral strategy, right? During volatile times, apart from all your investments, how you can diversify into a bit. Uh, there are two kinds of oil. One is Brent, which is UK, and then there is one is West Texas, which is WTI, US oil, UK oil, and US oil. Basically, whatever happens in Russia, Ukraine, it's concerned with Brent oil. Whatever happens with the US oil, that is connected with WTI or US oil. Both oils are tradable. Even on the live platform, if you see right now, if I type crude oil, this is Brent oil. Look at the price right now, 89.7. And then there is West Texas, which is US oil. Look at this. Price is 80. Let me close this out. is open. Yeah. Just want you to focus on these two oils. Brent, WTI. I hope everybody can see this. This is just one strategy, guys. You meet us and we'll explain you more on this. Now the Brent oil is $89 right now, and the US oil is $83. You can see that the difference between these prices around $5 or $6. Now, a lot of investors these days, they are doing market neutral strategies because of the high volatility. And you do these strategies after what portfolios you have already allocated, diversified, and everything. So this is something which is different going on in the market, these days. Let me show you a flyer over here, which was created back in 2021. Okay. Screen here. Let me share this tab with you. Here, sorry. One second. Yeah, right here. Brent and WTI. Yeah. Okay. Now I'm not going to show you anything else, just to this one thing. When you see this chart, says Brent WTI spread chart, right? If you, and I'm going to zoom this for you. Hope everybody can see this. Now what you see right here is not the chart of the prices of Brent or WTI. This chart represents the difference between, so the difference what you just saw in the oil price is $6-7 difference, right? Brent was 89, WTI was 83. This is the chart from 2016 to 2021, and I have the updated chart also, which if you want, we can share the strategy with you later on. Last 5 years, the price difference between both these oils have gone as high as $10, as you can see, the upward. It has gone as low as minus 0.16, which means the US oil became 16 cents expensive than the Brent oil. Now, how normally you use this strategy? These are called market neutral strategies because oil definitely, both of them, they move in the same direction. If Brent is going up, WTI is also going up. If Brent is coming down, WTI is also going down, right? The only thing is you're not trading on the prices, you're trading on the price difference. So what happens is online platforms allow you to do something called a short selling. Short selling means when you're anticipating a price fall, what you do is you borrow that commodity from your broker and sell it in the market live. When price drops, you buy it back at a cheaper price, keep the price difference with you, which is your profit, and the commodity goes back to the broker. We are more than happy to explain you how short selling works if you meet us. Now, both Brent and WTI move in the same direction, but we are not right now investing in the oil prices. We are investing in the price difference between this. If today the price difference is $6, you can see that in last 5 years, and when this flyer was prepared back in 2021, the price difference was as low as $2, right? Now that time, if you would see the chart and you see, okay, maybe in the next few months, the price difference between this will grow, right? So what you do is you buy Brent and you short sell WTI. Either Brent will go up and the price difference moves to 6, like right now it is, or WTI will come down and the price difference will move to 6 like it is. Either way, you have a buying position in oil and a short selling position in oil, two different kind of oil who move in a similar direction. So tomorrow when oil market goes up or down, you are less worried as compared to a speculator, because a speculator has either bought oil or short sell oil. He has only one position. Either you are buy on oil or short sell on oil. If you price goes up, you make money, but price goes down, you lose. But because you are trading on the price difference, you have bought one oil, short sell another kind of oil. So when market goes down for oil, this will come down, this will have a loss. But if this comes down, this will have a profit. So your loss is logged the moment you take a trade. Now the loss will only happen if the price difference narrows down, then it's your loss. But if the price difference increases, then it's your profit. This is called market neutral strategies, guys. These kind of strategies, they happen, like a lot of investors in volatile markets, they do this. So wherever the oil market goes, you are less worried about it because you're not trading on the prices going up and down. You are trading on the difference between these prices. which is 83 and 89 today, this much. Tomorrow, if you're expecting the gap will grow further, you can buy Brent and short sell WTI. If oil prices go up, this will also go up. Probably this will also go up, right? So your loss will still be locked, but it will be a profit if this goes up by a higher margin and this goes up by a lower margin. You will have profit in one leg and loss in another, but the profit in one leg will be higher than the loss in another. Like this, there are a lot of strategies which are built around Brent WTI, NASDAQ index in South Africa, gold and silver, MasterCard and Visa, Pepsi and Cola, all those relatable products which normally move in the similar direction. NASDAQ in South Africa was a different trade altogether. But then there are a lot of such strategies which you can look into, right? So, and another way, by the way, a lot of you who invest in stocks, they use earnings also, right? A lot of the people, they see earning season. By the way, talking about stocks, earning season is the best time to invest in stocks or buy stocks. The movements are wild. You just have to pick your stock, and we do something called as a price action analysis, and that is also something which you can look at. Let me just show you real quick, and this will be the last strategy before we move on. Let's see here. Look at this. I hope everybody can see this. Let me zoom this up. So sometimes what happens when you are using earnings, right? This is right now because markets are pretty one-sided. So probably we're not building these strategies as of now, but under normal market conditions, even high volatility, price action analysis is really important. So look at Expedia, for example. If I see that Expedia is going to declare second quarter earnings on August 6th, I will do an analysis on that in last 10 years, second quarter, if I would have bought Expedia stocks one day before the earnings and exited on the day of earnings, what my return would look like. Or if I enter on the day of earnings and hold on to for at least 1 week before I exit the trade, what would be my earnings in second quarter in last 10 years? Turns out, if in last 10 years you enter before the earnings date and you exit on the earnings date by the end of the market close for Expedia for second quarter in last 10 years, you will end up, there will be a 70% probability that you might end up making 2.5% gain on that trade. Maximum gain during last 10 years was 20%, maximum drop was 27%. Now what happened here? The probability is just 70%. But why it still became a strategy? Because it is still better than you speculating whether to buy Expedia or not. Now you know the numbers. If you enter Expedia a day before the earning and hold on to the stock by the end of the closing day, when the earnings come out, there is 70% chance, 70% probability that you might end up making an average profit of 2.5%. We calculated this, right? Second quarter, last 10 years. 70% probability. And see the next one. If you hold it for 1 week, the higher probability is of a loss, right? Look at these reds right here, -6, -6, -6, -4. Higher probability of 20% probability of gain in price, which means basically better to short the stock if you're going to hold it for a 1 week. So like this, again, guys, like this, there are a lot of strategies which are built around during the volatile markets, right? Your idea should be not only I should look at a long-term perspective, so keep some funds for the longer term, continue your SIPs, try to find out those stocks where you can take more positions, be invested, and then allocate a part to strategies also. Know your risk and reward. Okay, as I said, I'm just discussing the strategies with you. Doesn't mean that you go open a live account and do it right away. Please sit with us, talk to us, ask what is the risk in this, ask how much is I'm going to lose in this, right? Use the platform, see how to execute these trades. These are very easy to execute it. Talk about risk management, then enter into it, right? So today's session was all about the mistakes we need to avoid, strategies we can look at, past experiences, understanding how leverage works, right? That's the most important part, how leverage works and how overusing the leverage, you might end up losing the money and the entire capital what you have invested, right? Profit is all. And again, guys, before we leave, please remember this. Before you even think about profits, your entire focus should be, how can I minimize my losses? This is your investment mantra for the day. How can I minimize my investment losses? You focus on minimizing your investment loss, profit will happen automatically. But never think about how I should make money, how should I make profit. No. Just think about what strategy I should use that when market falls, my losses are the minimum. Just try to do that. You will realize doing that is much more difficult than earning money in the market, right? So once again, guys, before we end this session, a big vote of thanks to all those people who have their friends, their spouse, their relatives who are in the healthcare sectors. My big vote of thanks on behalf of my family, my company, my team here in Century Financial. A big vote of thanks to doctors, nurses, first responders, anyone out there in the field who have helped us out in the pandemic. They risk their lives day in, day out. If you're one of them, thank you so much. If you know such people, if you have your friends, your spouses who are doing this thing, a big vote of thanks. Pandemic is still not gone. We have still, we are still vulnerable to it, and I really appreciate what these fighters have been doing for us. Every doctor, every nurse, you deserve a big round of applause. And all of you, whosoever you are, if you're connected to any one of this, please convey my regards. We'll meet next week with a different topic, with a different session. And until then, please talk to your relationship managers. They will give you these practice accounts and come and visit our office. I'm available for a one-on-one training session with you. I'll tell you how to use this platform, what strategies we can look into, just to hear you out, nothing else. So once again, my name is Yogesh. Thank you so much. If you have any questions later on you want to ask, please reach me out. Please talk to your RMs. Let's have a one-on-one meeting sessions and let's make something out of it. So most importantly, be healthy, be safe, and be invested. That's something which is the most important thing I want to say.